Okay, good morning, everyone. I think we'll make a start. So welcome to Menzies UK Gap Update webinar. This update should last around 35 minutes, so hopefully there will be time to answer your questions at the end. If you would like to ask any questions, then please do use the Q&A function, which you can access from the icons at the bottom of the screen. I will try and answer your questions either as we go along or at the end of the webinar. And if I don't have time to answer all of them, then I will make sure to answer your questions via email. And there will be an email being sent out after this webinar with today's recording included. So before we begin, I wanted to quickly introduce myself. So my name is Bayan Aliar. I am the technical manager here at Menzies. I moved to Menzies in 2018 after a year of working within the audit team at Deloitte. I now am part of the technical team at Menzies. This is my first technical live webinar update, so please bear with me and hopefully you will enjoy this and start engaging with more of the content that we produce going forward. So what are we going to be covering on today's webinar? Well, firstly, in terms of 2022 amendments, you'll be pleased to hear that under FRS 102, there are no new amendments for 2022 reporting, which is a real positive, but I will be covering a few more general reporting reminders in this webinar. Next, I wanted to cover some more current topics and topical issues and the accounting implications for these. And I did actually draft the content for these slides several weeks ago now. And one of the slides I wanted to talk around was the cancellation of the planned increase in corporation tax announced by Quasi in the mini budget back in late September and what that will mean for accounting purposes. Well, unfortunately, I think that teaches me not to be so organised in future webinars because in the space of a few weeks, we no longer have the same Chancellor or Prime Minister for that matter. And this announcement has now actually been reversed. In fact, who knows, by the end of this webinar, there might have been a few more changes that I haven't foreseen. But the final point on the agenda that I wanted to talk about was just some more complex FRS 102 areas that I get asked a lot of questions on from clients. So firstly, in terms of Brexit, now it feels like quite a while back now since Brexit and some of the changes to companies law as a result of Brexit for December 2021 year ends and onwards. But I did just want to remind you of a few of the more important changes that occurred, as there were some good news and some not so good news in terms of for accounts preparers. The good news being changes for companies qualifying as a small company, and the not so good news of changes to the audit exemption for some companies. So for December 2021 year ends and onwards, in terms of the small companies regime, they've changed the definition of an ineligible group. So you can now apply the small companies regime if that small company is part of a group where another member of the group is listed on an EEA regulated stock exchange. Now, that didn't used to be the case. It used to be that if you had anywhere in the group an EEA listed company, you wouldn't be able to apply the small companies regime, even if that company met all other criteria, but now you can. It's only now if your group includes a company which is listed in the UK regulated market that the group continues to be ineligible and you still can't apply the small companies regime to anyone in that group. So in terms of what that means then, for example, if previously you had a UK subsidiary that in all other respects qualified as small, but it had a German listed parent, for example, previously you couldn't apply the small regime. As by having a German listed parent, it meant it formed part of an ineligible group. But after the 31st of December 2021 and onwards now, however, it's no longer ineligible. So this change is a positive one as it expands the companies that can now qualify as a small entity. In terms of the not so good news, I know this is a financial reporting update, but this is still quite a significant change for accounts preparers. And this is the subsidiary audit exemption via statutory guarantee, which is section 479A, part of the Companies Act. And the position is now that in order to qualify for exemption, that statutory guarantee has to now be given by a UK parent company, which is producing consolidated accounts. And it used to be that any EU parent company producing consolidated accounts could give that statutory guarantee. And now it has to be a UK parent. And so we're finding now that there are quite a few subsidiaries that are no longer able to claim this audit exemption anymore, and so are having to be audited for the first time. So it's just something that I wanted to remind you of again, is it's quite an important change to watch out for. So next, I wanted to discuss more current topics, which is surrounding rising inflation and interest rates. And apologies, it's not the most happiest of topics to touch on a Tuesday morning. However, unfortunately, this is trending upwards in comparison to where we've been over the last few years. And so there will be potential impacts on some accounting areas that are worth considering, and that I just want to talk around in a bit more detail. So the first is impairment of assets. So most impairment assessments are based on forecasts of future cash flows, either in a fair value model or in a value in use model, which I will cover in a bit more detail in a few moments. But judgments and estimates used in impairments reviews to determine the future cash flows should be based on current and forward-looking information, so especially that relating to inflation. So this will require more frequent and thorough reviews of those key assumptions. And also in the case of rapidly rising interest rates, that may mean that the discount rate used in the impairment assessments is also likely to need some revision. Alongside that, so secondly, given that we are in a period of volatile interest rates and foreign exchange rates, we might find that businesses may enter into more complex hedging arrangement to mitigate against those risks. And so many more may be thinking of entering into derivatives such as foreign exchange forward contracts or interest rate swaps. And I will be recapping on the accounting treatment for these under FRS 102 in a moment, as I do think this is an area that can be quite complex. And finally, we have a wider, more general consideration around going concern and potentially an increased risk that a material uncertainty could be present, as inflation is likely to increase the cost base throughout a business, and therefore we could see a reduce in profit margins. And it may be that supply chains of a business may also be put under pressure, and key suppliers or customers may go out of business. Or we might find that, for example, parent companies may be required to provide more support to other group companies impacted by that rise in inflation, but may themselves have that reduced capacity to provide support. And on the interest rate side, increasing interest rates could potentially lead to an increase in debt repayments, which could put a strain on cash flow. So extra focus potentially will need to be around bank covenants if it appears that they may be being breached, or where covenant breaches do occur, it's just important to negotiate any waiver with the lender prior to the balance sheet date, or that debt will need to be classified as current. So as I say, those are just a few more general considerations. It might be that they don't impact everyone, but it's just something worth thinking about with regards to rising inflation and interest rates. So just to touch on impairment in more detail. So this can be one of the more difficult areas in practice. So I just wanted to give you a brief overview of when an impairment review is needed and how the impairment review works. So under FRS 102, it very rarely requires regular impairment reviews. However, it does require you to look for indicators of impairment every time you prepare the financial statements. And this assessment must be based on conditions and impairment indicators that exist at the balance sheet date. And so as shown on the screen, this is very much a two-stage process. So firstly, you're going to look for general indicators of impairment. And if you don't see any indicators of impairment, you don't need to do an impairment review. But if you do see indicators of impairment, then you do need to do an impairment test. And why I mention this is that this could be particularly topical, obviously, is because I think given the current economic climate, it could present us with potentially more indicators of impairment, leading to perhaps more impairment reviews being undertaken. So impairment indicators could be lots of things. So it could be things like, for example, losses or obvious decline in asset value or changes in business, etc. As I say, if we determine that these indicators or indicators like this don't exist, then we need to move to the next stage of undertaking an impairment review. So an impairment review is where you compare the carrying amount of an asset to its recoverable amount. And the recoverable amount is the higher of two things. So value in use, so what the asset is worth if it's kept in the business for its whole useful life, and fair value less cost to sell. So what would you get for an asset if you were to sell it on the open market? And because of the way that calculation works then, If either of those numbers is higher than the carrying amount in the books, then you don't have to calculate the other amount. So if you know you can sell the asset for more than the current carrying amount, there can't be any impairment. So you wouldn't have to calculate the value in use as well, as you've already proved then that the recoverable amount is higher than the carrying amount. But if we're in a situation where the higher of both the value in use or fair value less cost to sell is still less than the carrying amount, then you would need to book an impairment loss. So that's whether you keep asset in business or sell it, you can't recover the carrying amount, so you need to write that asset down. Now, in terms of the two calculations for the recoverable amount, the fair value less cost to sell is often the easier of the evaluations, if there is readily available market price. But if it is very challenging to come up with, then often we're stuck with the value in use calculation. And the value in use is inherently complex, and it's about discounted forecasts into the future. And this can be more difficult due to the sort of uncertainty of the different cash flows. And it's very much down to individual circumstances and management of the company to do their best with those circumstances. So it's not an easy one to do in practice, but as I say, it is that higher of the value in use and the fair value less cost to sell that is important to determine here. Ongoing concern, I mentioned earlier, there may be an increased risk of material uncertainty, but more generally, when it comes to going concern and preparing accounts, there are two considerations we need to be thinking about. So firstly, is the going concern basis of preparation appropriate for the entity? So financial statements should be prepared on a going concern basis unless management intend to liquidate, cease trading, or have no realistic alternative but to do so. And in assessing whether the going concern assumption is appropriate, management takes into account all available information about the future, which is at least but is not limited to 12 months from the date when the financial statements are authorised for issue. And the point I really want to make on this is that it's quite rare for accounts to be prepared on an alternative basis or not on a going concern basis. And virtually in all cases, when you do see this, it's because the entity has already ceased or there is a plan to cease. And it's very unusual to have an entity that hasn't ceased or there's no plan to cease, but also recognises there's no realistic alternative but to cease. So even if we had a situation, say, for example, where the company is experiencing significant cash flow difficulties, there will often be realistic alternatives, and therefore it will still be appropriate to prepare those financial statements on a going concern basis. And that leads me really to step 2 on your screen. So after assessing whether the company is a going concern, you need to be considering whether there are any material uncertainties relating to events or conditions that cast significant doubt upon the entity's ability to continue as a going concern. So if as part of your management's going concern assessment, it's concluded that there are in fact material uncertainties, then those will need to be disclosed. And this is something that, as I mentioned earlier, we may be seeing a lot more of with companies disclosing material uncertainties, particularly as a result of the current economic situation and the uncertainties that have arisen as a result of that. So to give you an example, as a potential indicator that there might be material uncertainty is for those companies where, for example, we have a negative balance sheet, as that can mean that we have a situation where we're unable to meet the debts when they fall due, and that's the uncertainty element I'm talking about. But it may in fact be the case that, yes, we have a negative balance sheet, but actually the company are being very well supported by the parent company, who have the financial ability to support the subsidiary and are willing to do so, in which case that wouldn't be a material uncertainty. But if we have an example whereby the company has applied for additional borrowings to provide working capital, but the outcome of those applications is unknown at that stage, then that creates an uncertainty, and that would then need to be disclosed as a material uncertainty. And in terms of disclosure and what you need to disclose for going concern, if the accounts are prepared on an alternative basis, so the accounts are not a going concern, that needs to be disclosed. Or as mentioned, if there is a material uncertainty relating to going concern, then that also needs to be disclosed. And if the going concern basis of accounting is appropriate and there are no material uncertainties, then there are technically no specific disclosure requirements for the financial statements. But in the scenario I talked about, whereby if you had a negative balance sheet but are supported by the parent company who are in a strong cash position, then you may want to provide that additional disclosure for this for a true and fair view, as that's something that hopefully obviously is useful for the users to understand that information. And finally, I mentioned derivatives, as given the current period of volatile interest rates and foreign exchange rates, companies more and more may be thinking of entering into derivatives, such as foreign exchange forward contracts or interest rate swaps to hedge against interest rate risk and foreign exchange rate risk. And this can be quite a complex area under FRS 102. So I did just want to give you a bit of a recap on this. And this is something that hasn't changed under FRS 102, so there are no changes, but I think it is just important to recap. It's something I do get asked a few questions on, and it can be quite a tricky area. So firstly, in terms of what a derivative actually is, so FRS 102 defines a derivative as a financial instrument or other contract which has the following characteristics on screen. So its value changes in response to a specified variable. So that could be interest rate, financial instrument price, commodity price, foreign exchange rate, or any other sort of specified variable. Secondly, it requires no initial net investment or a very small initial net investment. And thirdly, it's settled at a future date. And the most common examples, as I say, that I see more often are foreign exchange forward contracts, and then sometimes I'd see interest rate swaps. So those are sort of typical examples we see, but as I say, derivative is something that meets any three of those on screen. So how are these recognised under FRS 102? So under FRS 102, derivatives are required to be recognised on the balance sheet at their fair value. And the way in which this works is over the months in which you enter into, say, a foreign exchange contract, foreign exchange rates are likely to fluctuate, and these fluctuations will generate a value for that foreign exchange forward contract. And it's that value that then gets reported on the balance sheet. And any changes in that value, so from one reporting period to the next, will be recognised in profit and loss. So on initial recognition, you would measure the derivative at its fair value, which is normally the transaction price. And as I said, derivatives normally require no initial net investment. So the fair value will normally be nil. So initially, there won't be anything to recognise in relation to derivative, but any transaction costs that occurred would be written off to the P&L. In terms of subsequent recognition, so any of these sort of foreign exchange forward contracts still outstanding at the year end will need to be fair valued and recognised on the balance sheet. And generally, you can get a value for these from the counterparty, so from the bank, and the bank will often provide monthly statements. So if you do have these type of contracts and these are outstanding, it's worth just making sure you do obtain a valuation for those. And then when you settle the contract, you again would need to calculate the fair value at the date of settlement, with any movement going to the P&L. And then you would clear out the derivative debtor or liability depending on the position. So in order to illustrate this, I wanted to work through this example with you. So on screen, you will see that we have a company called B Limited, which has a year end of 31st of December 2020. And they purchased goods from a supplier in France for 200,000 euros on the 30th of November 2020, so a month before the year end date. And they'll have to pay for those goods in 2 months' time, so 30th of January 2021. At the same time as this, they enter into a foreign exchange forward contract to purchase 200,000 euros at a contracted rate of 1.13. And on the table on the screen, you can see we have the spot rate at the 30th of November, 31st of December, and the 30th of January 2021. And we also have the forward rate to the 30th of January and at both the 30th of November and the 31st of December. So in terms of step one, the first thing you do with this transaction is to recognize the purchasing creditor. So you translate the foreign currency amount of 200,000 euros at the spot rate at the date of the transaction as stipulated under FRS 102. And in this case, the transaction date was 30th of November. So you use a spot rate of 1.12. So that would give you 179,000. So you would then debit your purchases and credit your trade creditors for that. So in terms of recognizing then your derivative alongside that, in terms of initial recognition, as I mentioned initially, there is nothing to recognize, but actually at the year end, so 30th of December, that contract hasn't closed out, so it's still outstanding. So you would need to recognize the derivative at the fair value with any movement going to the P&L. So you work out the fair value through comparing your contracted rate to the year end forward rate. And that would give you a gain of 1.6k. And the reason there is a gain is because the rate that you have actually contractually locked into is more favorable than the year end forward rate. So with the gain, you would then debit derivative asset of 1.6k and credit the P&L 1.6k. At the year end, you also need to recognize any foreign exchange gain or loss on the creditor. So under FRS 102, any monetary assets need to be translated at the year-end rate. That means you recognise the trade creditor at the spot rate at the year-end with any gain or loss going to the P&L. So the spot rate, as you'll see on screen, at the year-end is 1.11. So there's been an unfavourable movement. So you'd have to pay more, that means to clear out the creditor at the year-end. So you'd have a loss of 1.6k in this case. So you debit your P&L and credit trade creditors 1.6k. You then get to the settlement date of 31st of January 2021, and you need to settle your derivative. But first, you would revalue your derivative at that settlement date. So you compare your year-end forward rate to the spot rate at settlement. And in this case, you have a loss of 3k. So you would debit your P&L 3k and credit your derivative asset 3k. In terms of then settling the creditor, so your creditor at the year-end was 180k. So you would debit that to clear it out, but actually the exchange rate at the 30th of January is now 1.14. So there has been a favourable movement. So you would actually only need to pay 175,000. So credit cash, and then the balancing figure of 5k would get credited to P&L. So you then settle your derivatives, so you're now in a liability. So you would debit liability, credit cash to settle that derivative. And just to kind of give you an overview, so in terms of the impact in the P&L, so in December 2020 year end, you have a gain of 1.6k and a Forex loss of 1.6k. So that nets down to nil almost. And then in December 2021 year end, you have a loss on your derivative contract of 3k and a foreign exchange gain of 4.7k. So the net impact in that year is 1.6k, which is your overall total impact. As for the impact on your balance sheet, so in December 2020, you have a derivative asset of 1.6k and trade creditor of 180k. And then in your December 2021 year end, there is nothing in the balance sheet as everything's cleared out. So I appreciate, obviously, that's quite a whistle-stop tour through that example, but hopefully that has made it slightly clearer as to how derivatives should be accounted for under FRS 102. And as I mentioned, it's just worth checking whether you can attain a valuation from a bank if you will have derivatives that are outstanding at the year end, and make your auditor aware as soon as possible that you have the derivatives outstanding, as there will be additional work that they will need to do for that. So that's everything on derivatives. The last topic I wanted to mention is share options. And similar to derivatives, there haven't been any specific changes in this area under FRS 102, but I find that this is a particularly challenging topic, and it is one that I get asked a lot of questions on. So I did think it was just worth recapping the accounting treatment for that. So many companies incentivize and reward employees by issuing them with share options as part of equity settled share-based payment arrangements. So companies reporting under FRS 102 are required to account for the award of share options, meaning that even a small company reporting under FRS 102 1A will need to record those accounting entries. And often there can be confusion around the definitions surrounding share options. So I did just want to cover those briefly. So firstly, in terms of what a share option actually is, this is something that gives the holder of the option the right to subscribe to the company's shares at a fixed or determinable price for a specific period of time. So for example, say we had an employee may hold share option, which entitles them to purchase a share of the company, say £1 between the 1st of July and the 31st of December 2022, regardless of the company's share price at that time. And often attached to share options that are a vesting period. Now, this is a period during which the specified vesting conditions must be satisfied. So that will mean that an employee won't become unconditionally entitled to the share options unless those conditions are met within the vesting period. Now, that could be service conditions, such as the employee might be required to remain in employment for a set number of years, so say 5 years, or these could be more performance conditions, so achieving a particular profit target, for example, or on an exit event. And finally, we have the grant date, which is the date on which the company and the employee agreed to the share-based payment arrangement. And it's at that grant date where a company must measure the fair value of the share options awarded to the employees. Now, FRS 102 does set out how to measure the fair value of share options using a 3-tier measurement hierarchy, as shown on your screen. And it's the element of actually valuing those share options, which is commonly the most challenging area, and I think the area that businesses do struggle with the most. Because for many listed companies, they are more likely to be issuing options on a frequent basis, and that market data is just readily available. But for the majority of private companies and most entities that are applying FRS 102, there's only a very, very few that will actually have an observable market price for their shares or a recent transaction in the entity's shares. So in the majority of cases where market data isn't available, you would need to engage with a specialist to assist with calculating the fair value using an option pricing model, such as Black-Scholes model, and that's the most commonly used option pricing model around. And that takes into account various numbers of inputs, such as the share price, the exercise price, dividend yield, and the expected life of the option. And often some of these inputs can be quite challenging. And so we can actually assist clients with talking through those inputs and just providing you with further advice on where to get the relevant information from for each input to come up with a fair value. And one of the common misconceptions that I hear a lot around valuing share options is that the share price is the fair value of the option, but the share price is the price of one share of the entity. So this will vary over time and is different from a share option. So it's just really important to remember that the fair value of a share is not the same as the fair value of a share option. And once the fair value of the share options issued at the grant date has been determined, this is recognised as an expense in the profit and loss with a corresponding increase in equity. And if the share options vest immediately, so there's no conditions attached, and the employee is immediately and unconditionally entitled to the options, then the expense is recognised in the P&L immediately. But in situations where the employee is required to complete a particular period of service for unconditionally being entitled to those share options, so say an employee must stay employed for 3 years then that expense is recognised over the period. And this charge then gets adjusted each year to reflect the number of options expected to actually vest, as I'm just going to show you now on the next worked example. So if we take the example then on the screen, so we have A Limited who have granted 200 share options each to its 50 employees. Now the vesting condition here is that these employees will need to still be employed in 3 years' time, and then they will have the option to buy the shares at the end of the 3 years. So in this example, we have come up with a fair value of £10 at the grant date. Now, one assumption throughout the example that doesn't change is that fair value of the option. So in this case, the £10. And I think that sometimes does cause a bit of confusion, because I think people are tempted to say you would change that fair value over 3 years to reflect various different assumptions, such as maybe volatility. But actually, those assumptions have all been brought into that original assessment of that fair value at grant date. So you wouldn't change your fair value throughout that period. But an assumption that we would change is the number of employees that we think will meet the vesting conditions. So at the end of year one, the assumption has been made that only 90% of the employees will still be with company A at the end of the scheme. So we have then 200 options multiplied by the 50 employees times by the fair value of £10, and then multiplied by the 90% retention rate. And then we'll spread that cost over the period of the scheme. So we will recognise 1/3 of this cost in year one of the 3 years. So in the first year then, that will be debit P&L 30,000 as a staff cost and credit equity 30,000. And often companies choose to actually maintain a separate share option reserve within equity for that. Moving on to year two, so we'd reassess our assumptions in terms of how many employees will meet those vesting conditions. And so in year two, we're just less optimistic. So we only think that 75% of employees will stay. So if we multiply this by the 200 and then the 50 employees and the £10 fair value, and times that by the 2/3, so the 2 out of 3 years, that will give us £50,000. So then we'd have 50,000 minus the 30,000 that we've already recognised to date. So that would then leave us with debiting the P&L 20,000 and crediting the share option reserve 20,000. And then finally, when we get to year three, so the end of the vesting period, we now know, so A Limited now actually knows that 15% of the 50 employees have left and therefore failed to meet that vesting condition. So that only leaves 85% eligible. And so if we multiply that 85% by the 200 and then the 50 and then the £10 fair value and 3/3, that then leaves 85,000 minus 50,000 recognised to date. That will leave us with debiting P&L 35,000 and crediting share option reserve 35,000. Then following that, we have the exercise of the share options itself. Now this is completely separate, and it's a completely separate accounting transaction from the accounting for the issue of the share options that we've just discussed. So where a holder exercises their option and the company issues shares as a result, the company will record the following accounting entries on screen. So you debit your cash with the cash received, credit share capital with the nominal value of the shares issued, and credit share premium with the balance. Now, if a company has maintained a separate share option reserve, like we've seen in our example, then reserves transfer between the share option reserve and the P&L reserve may be made for completeness. So you would then debit your share option reserve and credit your P&L reserve. And that amount transferred will represent any balance in the share option reserve relating to the options which have been exercised at that point in time. So one final point I want to mention around share options is the disclosure requirement for these, because this can often be a tricky area and often has quite a lot of confusion around what we actually need to disclose. And often we do see that there's potentially an insufficient disclosure in financial statements for share options. So as a reminder, companies who are reporting under FRS 102 must adhere to those extensive disclosure requirements of paragraph 26.18 to 26.23 of the standards in relation to the share-based payments. And this includes disclosure of information about the nature and general terms and conditions of the share-based payment arrangement. And for equity settled share-based payments, how the entity has measured that fair value or equity instruments granted, so how they measured that fair value, if it's through a Black-Scholes model, as we've just discussed. And additionally, an entity is required to disclose the number and weighted average exercise prices of the share options for several groups. so including those options outstanding at the beginning of the period, any options granted during the period, and then exercised during the period. And there is also a requirement to disclose that total expense that has been recognised in the P&L for the period in relation to share options. So there's quite a lot in there in terms of extensive disclosure for full FRS 102 accounts. The entities applying FRS 102(1)(a), however, so for small companies, there are no explicit requirements for disclosure relating to share options. However, obviously there is that overarching theme that the accounts must nevertheless provide a true and fair view, and it may be decided therefore that the disclosure is actually required to achieve this if we do have a large number of share options that have been granted and quite a large charge. So that's everything that I wanted to cover on share options. As I mentioned, this is an area people do find challenging, particularly around determining that fair value of share options. And in these instances, it may be beneficial to speak with a specialist to assist in calculating that fair value, so using an option pricing model such as the Black-Scholes model. Which then leads me on to a quick poll question, just to see whether that would be something that you would like to have further assistance with. So if it's relevant to you and you do have share options, so if you could please answer the poll question, which should now hopefully have appeared on the screen, then that would be very helpful. I'm just going to give it a few moments, just to allow people to answer. Okay, great, thank you. So we'll just end the poll there. That's interesting, actually. So a few have said, obviously, that is something they would find very, that they do find challenging, they would want further assistance with, and then a few haven't, but it might be that actually you don't actually have share options and don't grant them. But as I say, in the future, if you were to issue share options, then if that's something you would need assistance with, then please contact us. So that's everything I wanted to cover in this webinar. I hope you have found it informative. In terms of the summary, we've obviously spoke about a reminder of some of the company law changes as a result of Brexit that affect December 2021 year ends and onwards. We've discussed some of the more wider topics for consideration as a result of the increased inflation rate, such as potential impairment of assets. And finally, we've just covered off some of the more challenging and complex areas of FRS 102, so that being share options and derivatives. So thank you so much for everyone for tuning in today. I hope you have found today informative. And if you have any questions that you can ask now, please ask them. Alternatively, you can see my contact details on the slide, and I'm always happy to answer questions. So please feel free to contact me, or if you wish to contact me to provide any feedback or anything you'd like to see us talk about in future updates, and I'm always happy to have any feedback as well. So I've kind of run over a little bit of time, but I think we have a short time left for questions. So I'll leave the chat open. So if you do have any questions, then please submit those to the Q&A. Okay, so we have one question that's come through. Am I right in thinking there is a change for dormant subsidiary exemption following Brexit? Yes, so previously dormant subsidiaries were exempt from preparing and filing individual accounts if the parent company was an EU parent. So for example, a subsidiary of a German parent would be entitled to take this exemption. But now for December 2021 year ends and onwards, this exemption is now only available for subsidiaries of UK parents. One question, I can understand how you calculate share options for years service, but how do you measure likelihood of meeting targets? Yeah, so often the ones that we tend to come across are, as you say, service when you have to be 3 years. If you have a vesting condition, such as like a profit target, etc., then that's an assessment that each year you'd have to say, how likely are you to be meeting that target? And then that would change your charge kind of accordingly. So that can be quite tricky, obviously, because it's almost based on sort of forecast where you expect to be. Are you going to meet that target? And depending on what the target is, some get baked into the initial fair value, but some actually get revised each year. So yeah, that's something. But I'm happy to, if you have a more direct question on that, I can answer that. If you have a more specific case, I can come back to you specifically on that. Okay, I think that's everything. Apologies if I've missed any questions. If I have, I can't see any on my screen, but if I have, then I will make sure to email you directly. And as I say, any feedback on the update or any questions you may have, then obviously please feel free to email or give me a call. But thank you everyone, and I hope you have a lovely rest of your day.